Are you looking for strategies to increase wealth and succeed in business? Understanding the distinction between assets and liabilities is essential for making intelligent business decisions and laying a solid foundation for your company's future. However, what are our assets and liabilities, and how can you use this information to increase your wealth? Before we continue, please click the like and subscribe for more valuable information we're about to share with you. In today's video, we'll discuss a key idea for financial achievers under the usual assets and obligations. This video is for you if you're prepared to take control of your money and establish long-term wealth. We'll be looking at assets and liabilities and how you can utilize this knowledge to make decisions that will help you build a solid financial future. The idea that assets and obligations are always simple to distinguish is widespread. Nearly everyone will likely remember that an asset is something physically present, like a car or a house. This is only sometimes the case, though. While tangible goods occasionally function as assets, they can also be liabilities. What constitutes a benefit, and what constitutes a liability, then? An asset earns you money or appreciates over time. A debt drains your bank account or lowers your self-worth over time. Rich Dad, Poor Dad, Robert Kiyosaki's best-selling book, was published in 1997. When Robert stated in his book that a property is typically a liability rather than an asset, it aroused many questions. It generated a stir at the time. What, then, is an asset if a domicile is not one? A liability requires ongoing spending or loses value over time, whereas an asset produces income, including cash flow, or increases in value over time. Therefore, accumulating as many assets as possible rather than liabilities is the key to building wealth. Using the classic example of a house, it can be initially difficult to determine if it is an asset or a debt. But if we stick to the criteria we gave earlier, a house might be considered an asset if it is capable of increasing in value over time. The house would be viewed as a bonus if its value rose or produced revenue as a rental property because it was doing one of those things. On the other hand, homes are typically viewed as liabilities because they require continuing costs like mortgage payments, taxes, insurance, and upkeep. It is neither producing income nor appreciating if the house's value decreases, grows, stays the same, or if the cost of ownership exceeds the house's value. In this instance, the house is a liability because it is depleting your funds rather than generating income. Generally, a property is more likely to be a liability until it generates income or is sold for a profit. It's crucial to carefully assess the potential of a house and its value to decide whether a home is a viable investment. The price of ownership and the possibility of making money through rentals or other ways. Another common misunderstanding about assets and liabilities is that, in the example of a car, people of legal age see a car favorably since it is material. This is only sometimes the case, though, as a car can occasionally be an asset if it is used for work and brings in money. Consider how your car might be viewed as an asset if you deliver deliveries or drive for a ride-sharing company like Uber because it brings in money. Because it puts money in your pocket, the railroad car is an advantage. On the other hand, a railroad car is typically viewed as a liability because it incurs recurring costs and loses value over time. It depreciates when you drive your brand new, glittering vehicle off the lot. However, costs for fuel, insurance, maintenance, and repairs can soon add up. Additionally, the car's value depreciates over time, so it will almost certainly be worth less than you paid. The car, in this case, would be viewed as a debt because it takes money out of your pocket rather than putting it in. Of course, there are exceptions, such as rare cars, collectibles, and other items that typically increase in value. Thanks to their distinctiveness and scarcity, we can better understand what assets are. It is impressive to distinguish between tangible and intangible assets. Tactile assets are real things with worth, like stock, machinery, and buildings. While in non-natural science, things of comparable value to intellectual property, such as trademarks and patents, are considered intangible assets. Physical assets include structures, infrastructure, and other natural scientific property, actual number undefined. Real estate can increase in value over time and generate income through rentals or sales, which can be positive. It could become a liability. Additionally, equipment like computers, machinery, tools, and other stuff might be advantageous if employed to boost productivity or produce cash. Both tangible and intangible assets can be priceless and add to the worth of a business or an individual. To ascertain which assets are most valuable and should be prioritized, assessing the potential for growth in value, the uncertainty of ownership, and the possibility of income generation is crucial. Real property has intrinsic worth. Genuine or innate appreciation of a resource is referred to as having inherent respect. The predictable future cash flows an asset will produce play a key role in determining its intrinsic value. Consequently, there is a relationship between assets and intrinsic value because assets that are expected to generate significant future cash flows or have unique characteristics are typically thought to have a higher inherent value. For instance, a rental property expected to provide stable rental income over the long term may be well advised to have a higher intrinsic value than a comparable property that is not producing income. The predictable future cash flows of financial assets like stocks and bonds give them their worth. Consider equities, for example, which rank among the most popular investment types and asset classes globally. Stocks represent ownership in a corporation. I like to think of stocks as a slice of pizza that can be cut into smaller pieces to help me remember them as a symbol of ownership in a company. Shares, or smaller fractions of a company's ownership, can be bought and sold on the stock market. When you own shares of a corporation, you essentially possess a little chunk of the business and are eligible to get a share of its profits. Consider the scenario where you own 100 shares of ABC Company. This indicates that you have a fraction of the company's total outstanding or marketable shares, which is close to 100. You are entitled to vote at shareholder meetings as a company shareholder and to partake in the firm's profits in the form of dividends or capital gains. Yes, through and through, capital gains or dividends are the two basic ways to create income or make a profit from stocks. The term capital gains describes the rise in the value of a stock over time. Consider purchasing a Sprout for $100 and selling it for $140 later. Dividends of $40 have resulted in a capital gain for you. On the other hand, it refers to receiving a share of a company's profits that are given to shareholders. For instance, each shareholder would receive a $20 dividend if a company made $200 in earnings and decided to allocate $20 to its shareholders. Dividends are payable in cash or more Sprout shares in the spring. In the same way that the value of a burger can change depending on the chef who makes it, its ingredients, and its quality, it is essential to note that the potential for generating income through capital gains and dividends can vary depending on the specific stocks that you are invested in and the company's performance. Depending on the company's public image and growth prospects, the value of a company's Sprout can change. The price of the company's stock is likely to rise if it is doing well and making new profits. In contrast, if the company is having trouble making ends meet, the value of its stock is likely to drop. This means that stock prices are not a one-way street and can fluctuate depending on supply and demand. But there are other elements, such as interest rates, inflation, and foreign elements. Knowing what you're doing may seem like a good idea, but it's not. So, just as you wouldn't buy stale bread at the store, evaluate the firms you want to invest in, ensure they have intrinsic value, and you are paying less than their estimated future value. When it comes to investments with intrinsic worth, you can also look for real estate or purchase a home. You can look for underpriced properties, such as those that have been poorly managed or have problems, and then restore their value by remodeling, rebuilding, or any other means necessary. Then, you can either resell the properties for a profit or rent them out to bring in regular income. In actuality, though, it could not be that simple due to several affecting circumstances. When done correctly, however, merely carrying stocks. And over time, they'll prove to be adequate resources for increasing wealth and income. Double down on plus accumulation while determining an asset or liability's genuine nature. To offset any liabilities, such as mortgages, credit card debt, debt from vehicle loans, etc., our business commitments call for regular payments and may deplete your resources. It is crucial to managing your liabilities to maintain financial stability and prevent getting overwhelmed by debt. Making a budget, paying off high-interest debt, growing your income, and investing in assets are easy ways to manage your money. Speaking of assets, knowledge is one that you will always need. Gaining new knowledge and abilities is crucial because knowledge is the basis for everything, making it your most valuable asset. Why don't you click the subscribe button to increase your financial literacy and make smart financial decisions? To summarize, understanding the distinction between assets and liabilities is the key to company success. This is done by concentrating on developing a portfolio of assets and creating passive revenue rather than just increasing liabilities and relying solely on active income. You can develop long-term wealth and attain financial independence. According to Robert Kiyosaki, the wealthy do not labor for pay. They have the resources to hire people. Therefore, if you want to join the ranks of the wealthy, begin establishing your portfolio of assets, and you are putting passive voice income streams in place right away. Before long, you'll be on the road to business freedom. We hope this curated material on understanding assets and liabilities was helpful and motivating. You never know who it might motivate to take charge of their destiny in business. Thank you for watching. Remember to subscribe and enjoy your day.